Welcome to part 2 of Bitcoin's institutional opportunity. As a reminder, the inspiration for this piece was an earlier report from Delphi Digital lead analyst Kevin Kelly, who wrote a brilliant piece called The Opportunity. In part 1 of this part 2 series, we introduced the opportunity for Bitcoin in the eyes of an institutional investor, given the issues of underfunded pensions and global debt concerns, leading to the potential for a move of money back into gold, and given the dynamics of this new digital world we live in, a move into digital gold or Bitcoin. In part 2, we continue this look at further factors driving institutional investors to find an opportunity in gold, and more importantly, digital gold, aka Bitcoin. The first opportunity for crypto we will look at in part 2 of this series, as highlighted in Delphi Digital's report, is the US dollar risk, or as they say, dethroning King Dollar. The US dollar is viewed as the global reserve currency. Why? The majority of global trade is settled in US dollars. Many commodities are priced in US dollars, and US Treasuries are the reserve asset of choice by global central banks, given liquidity and depth in the market. Whilst there are several catalysts for a stronger US dollar in the near term, Delphi note the demand side of the US dollar is more likely to tip the balance than the supply side. What does this mean? The US has in recent years weaponized the US dollar banking system, or SWIFT, against its enemies. This in part may account for Russia dumping its US treasuries in favor of gold. And as a trade war with China continues to escalate, there are fears that China may follow, at least slowly over time. It's easy to see how Bitcoin, a digital store of value akin to gold, but with lower inflation and added portability, liquidity, divisibility, and no storage costs, could fit into an investment portfolio seeking to hedge this US dollar risk. The second opportunity for crypto I will look at in part 2 of this series is deficits. Deficits matter in the long run. Whilst many mainstream US economists have argued deficits don't matter, should demand for US treasuries from abroad continue to notably decline, this will likely cause US treasury yields to rise and increase reliance on domestic purchasers. This would come at a time when the US is issuing massive amounts of debt. Delphi see the risk here as US Treasury issuing ever more debt to fund its operations, increasing the budget deficit, and potentially sparking an extended period of increasingly pessimistic sentiment towards the US dollar. Once again, it's easy to see how Bitcoin, a digital store of value akin to gold, could fit into an investment portfolio seeking to hedge against this US dollar risk. The third opportunity for crypto we're going to look at in part 2 of this series is risk return on debt. There are $10 trillion of negative yielding debt outstanding worldwide and growing due to monetary stimulus and bleak growth outlook. This means that when the economy does take a downturn, an inevitability after 10 years of growth, there is very little room to cut interest rates to support the economy. This low rate environment has led to investors taking on more risk for less yield over the last few years, a recipe for a world of investor pain when the market finally does turn. The fourth and final opportunity for crypto we will look at in part 2 of this series is related to equity valuations. The S&P 500 has gained more than 250% in nominal terms since April 2009, boasting one of its best performances in history. Whilst the US economy remains on a solid footing, the risk of a recession over the next 18 to 24 months is definitely on the rise. Stocks tend to perform very well in late cycle economies. The S&P 500, for example, has gained over 20% and 15% in the 12 months leading up to its pre-recession peaks in 2000 and 2007, but proceeded to fall over 50% on both occasions, from peak to trough following these highs. Valuations for equities are above their long-term historic averages across a number of key multiples, a strong indicator of lower longer-term expected returns for the equity market. In summary, the record-breaking recovery post the global financial crisis has left risk assets, equities and bonds, priced to disappoint over the next few years. Despite this record-breaking recovery, US pension funds remain vastly underfunded and heading towards crisis. This record-breaking recovery came at a huge cost to the taxpayer, with global debt hitting record levels as growth slows. Rising US debt, a slowing in the demand for US debt from overseas, and this slowing growth dynamic all pose a risk to the US dollar. Whilst historically these risks were hedged with gold, the rise of Bitcoin as a viable digital alternative in the minds of institutional investors should see Bitcoin's market share of this defensive trade increase. Bitcoin is also supported by demographic trends that support the adoption of digital gold, aka Bitcoin, over physical, whilst its properties of being a non-correlated asset over time make it a potentially interesting addition to any portfolio. Before we finish, I just want to make another big shout out to Delphi Digital, who created the content that we summarized today. It's great to see so many emerging resources become available to crypto investors that just weren't available 2 to 3 years ago. This was MaiCoin with MaiView. Thanks for watching.